Welcome to Implied with Zein, where conversations about value, strategy, and market signals are unpacked for the GCC markets, with insights that travel far wider.
Welcome back to Implied. So, capital allocation or the cash deployment strategy. To me, it's probably the single most important signal a company sends about whether they know how to create value. And it really comes down to three questions. How much to invest, how much debt to carry, and how much cash to return to shareholders. Companies that get those decisions right tend to create value, and those who don't, well, they tend to destroy value. Because capital allocation is a judgment exercise. It reflects how management weighs time and risk and opportunity. The balance sheet and cash flow statements tell you what they've done, but the pattern over time tells you how they think. Now, in theory, the objective sounds clean and simple. Make sure that the company has enough capital to pursue its strategic objectives and also survive any potential shocks. In practice, of course, it's quite messy because companies operate in cycles, under uncertainty, and often with incomplete information. So if there isn't enough capital, the company either passes on good opportunities or risks going into financial distress. If there's too much capital, on the other hand, the company sits on idle cash, unless, of course, they hand it back to shareholders in the form of dividends. So let's walk through some of the ways companies deploy capital. The first is investing in organic growth. And this is typically the choice that creates most value. Think back to the companies we used in episode 2, Talabat, SABIC, and that Brazilian agribusiness. They can't unlock the revenue or margin without putting money to work. And the cleanest way to do that is usually through organic growth, organic investment. For Talabat, that might mean organically expanding into new cities, upgrading the platform, or growing the delivery network. For SABIC, it could be organically expanding downstream into higher value chemicals. And for the Brazilian agribusiness, organic growth can take the shape of investing in advanced irrigation systems. The beauty of organic growth is that it builds on existing strengths like internal capabilities and customer relationships. It compounds over time and without the integration risks of acquisitions. And that compounding effect is why the best performing companies stick to organic investment as their number one capital allocation priority. But sometimes time is the constraint. The market is moving faster than internal capabilities can catch up, and that's where acquisitions come in. Acquisitions can be powerful. They can accelerate scaling efforts, bring in new capabilities, and get a company into new markets much faster than building them from scratch. Think of Talabat acquiring smaller applications to consolidate market share. Think of SABIC buying a specialty chemical firm to diversify beyond the commoditized products. Or the Brazilian agribusiness buying a logistics company to control more of the supply chain. These are hypothetical examples, by the way, but of course, acquisitions come at a price. Many deals involve paying a premium, and premiums dilute returns. The premium often reflects management's conviction in a narrative, but the danger is when that turns into overconfidence and when the numbers are stretched to fit the story. So the risk is high. Integration failures, cultural clashes, and overestimating synergies. That's why the vast majority of M&A deals fail. The difference between a great acquisition and a value-destroying one usually comes down to solid due diligence and a realistic integration plan, and most importantly, the acquisition price. Even then, there are no guarantees. Of course, sometimes creating value isn't about adding more, but actually about letting go, which is why some companies divest. Divestments are not always thought of as capital deployment. They're more like capital reallocation or redeployment. For a company like Talabat, divestment can be in the form of shutting down a loss-making geography. SABIC could sell a non-core unit that doesn't fit its strategy anymore. The agribusiness firm might sell a low-yield farm. And again, these are hypothetical examples. Selling a business unit, a segment, or a portfolio company can create value if it no longer supports the strategic objectives. And if the perceived value of selling it is higher than the value of keeping it. Divestments simply reduce complexity, and they allow management to reallocate capital to high return areas. Next on the list is investing in working capital. It still surprises me how this one is often overlooked, even though it's incredibly important. Working capital tells us how efficiently a company converts revenue into cash, and it shows more about operational health than what the income statement captures, in my opinion. And here, good use of cash actually means not using it. In fact, the best case scenario is when growth releases working capital instead of ties cash in working capital. When the cash conversion cycle turns into inflows rather than outflows. And you see this in certain industries where customers pay upfront. But growth usually demands cash for most other industries. You have to invest in the sales cycle one way or another, whether it's building inventory or offering credit terms or funding receivables. Next on the list is financing choices. Deleveraging can make a difference if it genuinely reduces risk and lowers the cost of capital. For example, if a company moves from an inefficient capital structure to one that investors consider more balanced, the valuation may go up. But financing's real goal and objective is to support strategy. It enables everything else. It gives companies the capacity to fund growth and invest in operations, to basically pursue the value drivers we discussed in the last episode. Finally, we get to the one decision investors watch most closely, and that is how management rewards them. Cash dividends and share buybacks can be the right move to make when there are no better capital deployment opportunities, simply. Dividends can provide predictable returns to shareholders, and they signal stability. Buybacks can signal confidence in the company's long-term prospects, if they're done at the right price, of course. So, to summarize, investing in organic growth, acquisitions, divestments, working capital, financing decisions, and shareholder distributions. Again, the order shifts depending on the business. Mature business, for example, with limited growth prospects, might get more value from optimizing their working capital, and high growth business might benefit from deploying its available cash into organic expansion instead of paying dividends. So how do diligent companies decide where to deploy capital? Every time a company puts cash to work, it asks three questions. Does this fit our strategic objectives? Does it create value? And how does it rank against other alternatives? I've seen companies that often move ahead with an initiative, even if it looks good on paper, by the way, but without comparing it to other possible uses. And that is why mature companies think in probabilities. They don't ask, is this good? But they ask, is this better than everything else we could do with the money right now? So what's implied here? It's simple. Investors follow the cash. Because at the end of the day, capital allocation tells a story. A story about priorities, about competence, and ultimately about purpose. Where companies spend their cash and how they justify that spending is what investors use to judge value creation. And capital allocation on its own doesn't mean much unless it's creating value. And that's where we'll pick up in the next episode. We will discuss value creation and how profit making is often mistaken for value creation. I am Zein, and this is Implied. Thanks for listening.
You've been listening to Implied. If you found this useful, follow the show and share it with a colleague or friend. It helps more people discover the conversations. For episode alerts and show notes, subscribe at impliedpodcast.com. And if you have thoughts, questions, or even pushback, we'd love to hear from you. Remember, nothing here is an endorsement or investment advice. Thanks for listening, and see you next time.